been a while since you've been on, about May. Lots happened since then.
Yes, I've been away in the UK, so I was there on the run-up
For the
to
Brexit.
for the Brexit. I wasn't there for the Brexit, but I just happened to be there at the same time as it was all running. And it was really very interesting, this issue of, does it matter about what the facts are? It's all about feelings. And both sides were sort of saying it's going to be terrible if we leave, it's going to be terrible if we stay in. Things have turned out, it's not been so good deciding to leave. Remember, it's going to be 2 years before they actually leave. And at this point, the Article 50 hasn't been triggered, which is when they start to put things into place ready to leave. But certainly there's been some considerable negative reactions around the place. The bottom's falling out of the market for commercial property in London. The pound's base rate's been cut back to 0.25% from 0.5%, which goes back to that question about, you know, what's left for reserve banks around the world.
Inflation.
Well, that's the problem. There isn't any. And so most of the developed world, reserve banks are cutting rates. In some places they're negative. And our own reserve bank this week is facing up to cutting another quarter. Hopefully they'll do a half, because currency is overvalued right now, which is certainly not bringing a smile to many exporters. But the problem for reserve banks is that the monetary policy that we've all come to love and loathe, I suppose, depending on which side of the fence you sit on, it's basically losing its ability to do very much. You know, you could change when we had interest rates at 6, 7, 8%, you could sort of play around and 1% made a difference. But when it's at 0.5% or 1%, does a quarter really make that much difference? So the efficacy or the weight of monetary policy is sort of losing its way, if you like. And maybe governments one day are going to have to start making government decisions again, rather than blaming it all on the central bank.
Pointing to somebody else. Yeah.
It's not our problem. It's these, you know, we've got an independent central bank and they make the decision. But clearly the currency has lifted from mid-60s, now it's low 70s. That does bring pressure back on to exporters. That brings pressure back on to farming, the primary sector. And things aren't looking too flash in the areas where we make a living.
House prices, that you keep bringing that up.
Well, that's the rock and the hard place. We cut interest rates, that reduces debt servicing, that makes tax-free capital gains on property all the more attractive, and that brings landlords, people with equity, into the market, lifting up prices, freezing out the youngsters coming through who can't get onto the ladder. And I think we saw 13.5% average house price increase in Auckland last year, against a backdrop of wages moving about 1.5%. Well, you don't need to know much about arithmetic under those circumstances to say, I can't save myself into a house. And that actually starts to attack the fabric of what being a New Zealander is, I think. If you don't have that sort of, it's not a quarter acre anymore, it might be a bit smaller, but at least there was that aspiration to be a homeowner for most people.
Where do bonds fit into all this? Because people say when times are tough, you look at bonds.
Well, you think about bonds. What are bonds? They're basically a loan agreement. I give you some paper, you give me some money, and I'm going to pay you a certain coupon rate or an interest rate on that bond. And because the world is really difficult right now, interest rates are very low, we see bond markets starting to lift a bit. This morning in the Herald, New Zealand has the mantle of being the most expensive bond market in the world, which, surprise, surprise, that starts to see money coming here. I think we're running at just under 2%. The US is just over 1%. And good old Switzerland's at minus 0.8%. So you sort of, you know, there's quite a range of policy implications when we talk about those sort of bond rates.
So what else should we be aware of as far as that whole piece of knitting?
Well, I mean, the world's an uncertain place. I think you look at the uncertainty in North America, you look at the uncertainty in the UK, the uncertainty in Europe, and that actually means that it's probably, you know, I think we talked about it 2 or 3 years ago, it may be time to sell the toys and sort of batten down the hatches, because things are going to be a bit tough for a while.
Let's look at the American thing. How much of a result are we going to get as far as the economies around the world?
In terms of how will the America knock on to the rest of the world? Well,
and we've got the election, it's uncertain, isn't it?
yeah, I mean, we've got this sort of protectionism starting to build in the US, which could be bad for global trade. And it's sort of a real challenge to pick which way it's going to go.
Because you've got a philosophy about Trump and about...
Oh, I just saw it this morning, and it was a sort of the election in a nutshell. If it's about Hillary, Trump wins. If it's about Trump, Hillary wins, and Trump would like it to be about him. Yeah, it's really the bottom line for that. The guy is so narcissistic, he can't even bring the election to be about Hillary. He'd do it for himself, even though he's going to lose.
Yeah, I think he keeps shooting himself in the foot because he doesn't listen.
Well, I think that there's sort of what we've gotten used to with politicians is they make the odd mistake, but they don't make mistake on mistake on mistake on mistake. Trump makes so many mistakes, it's hard to pin him on one because he's made 3 more since. So people are running around trying to nail it down. But it's still you know, if you're a news junkie or a political and economic nut, it's the best show on earth still.
Yeah,
and it's
how's their debt level in the United States?
Well, the debt level's now starting to accelerate faster than 2007. So we are back into sort of pre-GFC debt level growth in the US. We've seen 10-year loans on cars now. We can't do it on houses anymore. They've been beaten to death. So now you can borrow money for 10 years on a car. Well, we do see 10-year-old cars around, but generally you sort of, if you buy them new, you've moved them on before then.
So the other thing is just literally percentages and all that sort of thing. I mean, you've got mortgages and things over there.
Oh, mortgages are still low. I mean, all of the liquidity that the central banks have pushed into the system has to go somewhere, and it goes into assets, houses, land, and it goes into equities, the stock market. And so houses and the stock markets are vastly overvalued. And that's really the story right around the Western world. We've got overvalued assets. You know, the average $1 million house in Auckland. You needn't look any further than Auckland to see
exactly
how it happens.
Let's look at New Zealand, dairying, and how are we off?
Well, you know, sort of current, the last dairy auction was up 7% and a bit from memory, but it was certainly up, first time in several weeks. But the prices are still too low to sustain a predicted $4.25 payout, and I'm told currently the break-even's about $5.05, which is, I mean, that's painful. And this is what, the 3rd season we're going into now. So for the producers in New Zealand, it's painful.
And really, there's no light at the end of the tunnel. It's actually a train coming the other way at the moment.
Well, I mean, the fact is that we're in a global economy that's got too much debt around the place. That debt is actually suppressing demand. Demand suppressed means we're selling into markets where there is an excess of supply, which means prices are lower for longer.
Construction's doing all right, though.
In New Zealand, absolutely, doing quite well here, and the political pressure is starting to build to get behind house building, because the idea is to fix the high prices with more supply. So you build more houses, because there's more houses, prices fall. But there's a limit to how fast you can build houses. And I saw a piece somewhere, somebody said, we need to build more houses in the next 25 years than we built in the 161 years from 1840 actually in New Zealand. So we've got to do in 25 years more houses than we did in the first 161 years, which gives you an idea of how steep this particular supply side approach is.
And of course, very briefly, we've got the New Zealand dollar.
And the New Zealand dollar's hurting us. In the low 70s with still upward pressure, largely because of with a standard bearer for interest rates in a low interest world. While we continue to sit in that position, while we continue to fail to deal with the demand side of housing by macroprudential measures, LVRs, limiting debt to incomes. Well, until we start to do those sort of things, we won't really fix it quickly enough to catch up with where the world is.
Thank you very much indeed.